Let's be brutally honest. A lot of people walk into NFTs thinking, this is a new world, old rules can't touch me. It sounds exciting, but in the United States, the tax system doesn't care whether you call it a JPEG, digital ownership, or a cultural revolution. Taxes ask one cold question. Did you earn income? Did you realize gains? Did you make transactions? And if the answer is yes, you report it. That's it. You can love NFTs. You can make money with NFTs. But you can't become invisible to the IRS just because your activity happens on a blockchain. The reality is that NFTs make things more complicated, mostly because of records, valuation, and classification. If you want to treat this like a serious crypto investment, you need to respect the boring stuff: documentation, discipline, and clarity. Now let's go step by step, clear, practical, and straight to the point. In the US, NFTs are typically treated as part of the broader category of digital assets. Each year when you file your federal return, you'll see the digital assets question. During the year, did you receive, sell, exchange, or otherwise dispose of any digital asset? Many people treat it like a formality. It's not. This is where crypto investment becomes real, because the goal isn't just making gains, it's keeping what you earn after taxes and after mistakes you could have avoided. So here's the most important question. When do NFTs create a tax bill? The core rule is simple. When you dispose of an asset, meaning you sell it, exchange it, or use it to get something else, you can trigger a gain or a loss. And in many NFT cases, that's capital gain or capital loss. Capital gains come in two flavors: short-term and long-term. Short-term is holding for 1 year or less, usually taxed at ordinary income rates. Long-term is holding longer than 1 year, often taxed at more favorable rates. But there's a big catch. Some NFTs may be treated as collectibles, and if an NFT is classified as a collectible, long-term gains can face a higher maximum tax rate than typical long-term capital gains. That changes how you plan, how you hold, and how much you ultimately owe. The more you buy assets tied to art, images, or clearly collector-style items, the more seriously you should take this possibility. No panic, just awareness and preparation. Next comes the part that gives people the most headaches: records and valuation. You mint an NFT for 0.08 ETH. You pay gas. A few weeks later, you sell it for 0.5 ETH. You say, "Great, I made money." True, but taxes ask something different. What was your gain in USD at the time of sale? And what was your cost basis in USD at the time you minted or purchased? Do gas fees add to your cost basis? Do platform fees reduce your proceeds? In practice, yes, because US tax reporting is measured in dollars. And here's the common mistake. People remember ETH, but they don't record USD. Yet the IRS calculates gains in dollars. You can say you sold for 0.5 ETH, but if you don't know ETH's USD value at that exact time, you can't properly compute your gain. If you can't compute it, you guess. If you guess, you increase risk. It's that simple. Now consider another extremely common scenario: trading NFT for NFT. People love to say, "I didn't cash out, I just swapped." But from a tax logic perspective, you disposed of one asset to acquire another. That can trigger capital gain or loss based on the fair market value of what you received at the moment of the swap. In plain language, you don't need to withdraw to a bank account to create a taxable event. You may dislike that, but it's the rulebook. Let's talk about airdrops, rewards, and income. You receive a free NFT from a project. You earn tokens as a reward for participation. You claim something from a community or protocol. In many situations, what you receive may be treated as income at the time you gain control of it, and it has determinable value. This matters a lot for crypto investment because investors often focus only on buying and selling while ignoring received assets that quietly create tax obligations. Now let's speak to creators, artists, builders, founders, and people launching collections. If you mint NFTs and sell them, you earn revenue. If you receive royalties, that's revenue too. In many cases, this isn't capital gain, like an investor buying low and selling high. It may be treated as ordinary income from business activity or self-employment. And once you step into that world, you're dealing with expenses, bookkeeping, and potentially self-employment tax. This isn't meant to scare you, it's meant to prepare you. Now we move to a topic that's becoming more and more important: reporting through platforms, brokers, and systems. In the past, many people relied on a feeling of no one knows. But the world is moving toward more standardized reporting for digital asset transactions. As third-party reporting increases, matching and verification becomes easier. That's why, for long-term crypto investment success, your best advantage is not secrecy. It's clean records and accurate reporting. And now I'll give you a workflow that is simple but extremely effective. Step 1. Build a transaction journal with date/time, wallet or exchange, transaction ID, what you sent, what you received, fees, and the USD value at the time. Step 2. Classify into 3 buckets capital gains/losses, income, and uncertain items to review later. Step 3. Understand that the more you trade, the more you multiply record-keeping risk. Now, the part everyone loves: legal optimization. That means planning, not loopholes holding periods, real loss harvesting, timing, and proper tracking if you're a creator. This is exactly what strong crypto investment looks like in the real world. Finally, remember 3 lines: if you sold, swapped, traded, or received rewards. Assume there may be a tax issue and check it. Records are your lifeline, and transparency is increasing. I'll close with a reminder. This is educational content, not personal tax or legal advice. But if you record transactions, understand taxable events, and report honestly, you will already be ahead of most people.